Thought I wanted to be in Hollywood, and now I'm working bridging. I was cleaning windows for a little while, and then woke up one morning in a nightmare that I'd fallen from a sash window in a townhouse and decided I didn't really want to be doing that sort of job anymore.
You're a senior business development manager at Octane Capital. With over 14 years experience, you built a reputation for structuring complex bridging, refurbishment, development, exit.
So the big volume for us is on refurbishment funding. We have funded over 1,000 refurb projects. We like skin in the game. When you're dealing with a refurbishment, things can go wrong. It's very easy for them to throw the keys at Octane and go, sorry, I've messed up. Can you go finish this?
Yeah, it's no skin off my nose.
Valuation of this flat was £14 million. The valuer's comment said, this is one of the most illiquid properties we have ever seen, and we expect time to sell of more than 24 months. Now, would you want your client to borrow off of the OMV in that situation on a 12-month bridge?
I just want to tell you that this is a very, very risky thing to do. So as long as you are aware of this and you understand the consequences of not being able to repay. This episode is sponsored by Merry Oaks Property Finance Brokerage. Merry Oaks is a finance brokerage for investors, developers, landlords, SMEs across the country, helping you with all of your finance needs. So whether it's bridging, development, commercial, buy-to-lets, HMOs, service accommodation, industrial, hotels, the whole 9 yards, whether it's for your portfolio, whether it's for your business, we can support you. Please contact us. We've got the link in the show notes, and we look forward to hearing from you. Now, back to the episode. Hello, everyone, and welcome back to another episode of Property People. I am delighted to be joined by Mr. Mark Stephenson. How are you today, Mark?
Well, thank you very much.
Good. Right, Mark, we are going to be talking about one of my favorite topics is property finance.
Yep.
And you've got lots of experience. May I say that out of all of the business development managers that we speak to and people in property and lending and that side of things, I'd say probably you're one of the most knowledgeable people.
Wow, okay.
That comes across from that side. Yeah, absolutely. And enthusiasm as well for what you do. So it really is, genuinely, like the level of technical knowledge. I remember every Monday we get on a call with a bunch of brokers and you went through a whole bunch of detail. And we do this every Monday. So we see different people present in different ways. And every single time that I've been with you and sat with you, it was notable how much detail and how much enthusiasm you have for this stuff.
Thanks. Well, I think a lot of that becomes down to where, especially with Octane, we have a core niche of products, become experts in that field. So I don't have to worry about commercial or buy-to-let. So it's easier to talk more knowledgeably about a core set of activities, I think.
You too modest, yes. I mean, because it is a complex area to begin with. But you are right. You're very, very focused, and there's always merit to that as well. So just a quick little intro as well for you. So you have been you're a senior business development manager at Octane Capital.
Right.
You've been lending since 2012.
2017.
But how long have you been in the game?
I have been in finance for 15 years and with Octane for just over 5.
Exactly. And you've previously been with Castle Trust?
Correct, yeah. 4.5 years there.
4.5 years. So with over 14 years experience, you built a reputation for structuring complex bridging, refurbishment, development, exit, and working with SME property developers and investors across the country to get their deals over the line when they don't typically fit with your kind of conventional high street lenders. So
Exactly.
you're very much in the specialist lending space. So before we get into all of that, I would like to find out a little bit more about who are you, who were you at school in particular,
Right.
And were you studious? Did you always know that you'd want to be a bridging lender?
No, I mean, I don't think anyone, not everyone falls into property because it's not something that they deem to go into from the very outset. I mean, I remember even when my missus was trying to get me to move out of home saying, why are you trying to take me away from my mum? So I didn't really have aspirations to necessarily own property. And now it is all I talk about every day. But going back to school, I thought school was not necessarily too challenging. So it meant that I was sometimes a little bit of a joker, a bit disruptive in class. But my main focus when I was in secondary school certainly was actually going back to your previous interview with Kim McGinley, was I also was on the acting and dramatic side of school.
Is it?
Absolutely, yeah, and studied it at university as well. So
Okay, wow.
I thought I wanted to be in Hollywood, and now I'm working bridging.
Very similar field.
Exactly.
So tell me a little bit about school. So GCSEs, you got those A levels.
Yeah,
you got
yeah,
those.
yeah.
You went through to university. Where did you go to university?
I went to Middlesex University,
Okay, and
which
you
is
did
in
drama?
North London. Yeah, did drama, theatre arts, a bit of directing. Hardest exam I had was actually 7 minutes of stand-up in a pub in North London.
Oh wow.
Massive rush, terrifying. Hence, I never did it again.
Did you get eggs and tomatoes thrown at you?
No. Rapturous applause and laughter.
Good man. And so, well, that is quite the thrill. That is quite, that's living the dream for many people.
Mm-hmm.
And you're in London, close to London at least?
Yeah, so I grew up in East London, moved out a little bit more. Now I've got 2 kids, moved out that little bit further. So
Whereabouts did you grow up in East London?
Near Stratford. I went to school in Stratford. I grew up in
Okay.
Beckton in the Docklands. I know an area that you know very well.
Yeah.
But yeah, just edged out bit by bit.
Okay, got it. And so yeah, you're in the midst of it. So why didn't you continue the career and the aspiration to become a Hollywood actor?
It's real tough out there. I mean, I did some sort of odd jobs here and there with extra work. So I was a stand-in for Nicholas Hoult for a little bit. When he was in About a Boy.
Okay.
But a stand-in is like the opposite to a stuntman in that I do nothing, stand in the shot, get all the rain and stuff thrown at you, and then when they're ready, the star comes in, and I go and have a hot dog or something in the van.
That was the extent of the claim to fame that you had.
Exactly,
Okay.
that is it. Oh no, another claim to fame is I was in the background, and you can see me in one of the X-Men movies.
Is it?
I think I was typecast because they had me coming out of a pub, stumbling.
So, so you decided at some point. Do you remember the moment that you thought, "No, I need to do something else"?
Yes, I was cleaning windows for a little while as well in North London, and then woke up one morning in a nightmare that I'd fallen from a sash window in a townhouse, and decided I didn't really want to be doing that sort of job anymore. And obviously, as it comes down to it, and as boring as it sounds, is that there was bills to pay. So I put my CV up on a job board, and a really interesting role came through for the first lender that I worked for, Borrow. So we were an online pawnbroker, lending on, quite glamorous things: watches, diamonds, artwork, cars, which was the main interest for me. And that was my first foray into finance.
It was called Borrow, yeah?
Borrow,
Is that still around?
Yeah. No, I think in the US they're still going. And then Borrow then pivoted into doing bridging finance as well. And that was my sort of first taste of property finance.
Wow. Okay.
Yeah.
And so just give me an idea of what that office looked like. Was it a big kind of was it a retail unit? Was it a big office? Was there loads of people there? Was it a boiler room? Was there loads of people on the phones?
Yeah. So it was very much startup. So heavy on the marketing, PPC, etc.
Right.
We had the sales team to deal with the inquiries that came through from those sources. There was a small introducer network that would introduce clients to us as well. But interestingly, and very right for the type of business, was that we were based at the London Silver Vaults. So any of the high value jewellery, watch items, etc. would be stored at the London Silver Vaults, which was one floor below where our office was. So we're really well situated for that. Of course, we couldn't store any cars there. They would be off in a separate facility. Wine and artwork in specific facilities for those types of assets as well.
So you used to get things. I mean, whiskey is also an interesting asset class. Would be like,
yeah, didn't really see too much whiskey, but a few cases of wine. Artwork was very big. The
watches,
loads of watches. Yeah, artwork was massive in the New York office because there's a big art scene over there. But yeah, the cars was my favorite thing to lend against.
Tell us a little bit of like, did you have a memorable car that they were like came to get a quote from you?
Yeah, I mean, so we had a lady that had a massive collection of Lamborghinis from the 1960s.
Wow.
A couple of them that were more or less exactly the same, but when they found out there were a few tweaks on one of them, they wanted the actual original one. And there must have been, I mean, she must have had 10 or 15 of those. But yeah, going to do a photo shoot up at the car storage facility was like an Aladdin's cave for petrol heads. This place was insane. But it was mostly the classic cars that we used to do more of as well.
And just out of interest, because this is all interesting for people that are just in finance in general and thinking to diversify into one thing or the other, and we'll get into kind of bridging finance and how many lenders there are in that space and how competitive it is. But for pawnbroking, like typically for a Lamborghini car, what's the LTV and what's the pricing that they normally used to quote?
So we were at, say, 55, maybe 60% on vehicles.
Right.
Because they're slightly less liquid, should I say.
Absolutely.
Jewelry, watches, 70, 75%. And then artwork was, again, usually 45 to 50. The reason why the artwork was a little bit lower is because to get the right artwork in the right auction, if a loan were to default and we have to sell the artwork, you might have to wait 6 months to get it in the correct auction.
Right.
Watches and jewelry change hands all the time.
Got it.
So it's, again, all about liquidity, similar to how bridging lenders approach property.
Isn't it? Yeah, there's always similarities and crossovers. And so now and what was the pricing on all this sort of stuff?
I mean, when I first started, we were taught it was about 5% per month.
5% a month?
A month, yeah.
Jesus Christ, so that's 60% per annum.
Yeah.
Okay.
That's good for pawnbroking. I think the average at the time was maybe 8 or 9%.
A month? Wow.
A month, yeah.
We're in the wrong game.
Well, I mean, that business was born out of 2008 when a lot of people had a lot of shiny stuff.
And they needed liquidity.
Exactly. And a lot of the conversations that I was having with our clients was, they're like, I need £30,000 by the end of the day, which is something we could easily provide, usually within a couple of hours. What's the reason for it? I'm doing a property transaction. I'm slightly short on the deposit. And I need this done now. So I could see that there was always a link to property, and a lot of the people who had these beautiful assets that we were lending against had involvement within property as well.
Interesting. And that was the first foray for you into property because they started to lend bridging.
Exactly that, yeah. Because when a lot more lenders sort of started coming to the market, bridging lenders came back in. A lot of people had, it was easier to borrow against property than it was sort of 2008 to 2010. So we saw that as a trend that we wanted to get back into as well. So
was this around 2012-ish?
I started there. Oh, God, you're going to push me now. Yeah, it must have been about 2012 I started there.
Okay. Okay, so now 2012. Just pull that microphone a little bit closer to you if you can. That's good. So 2012 and your first bridging, like how did that come about in terms of they just came in and said, right guys, we're gonna now get inquiries for bridging finance.
Yeah.
Was there any training for you? Yeah,
so we had a couple of underwriters come in that had worked for bridging lenders in the past. We had the head of bridging credit that had worked for Marsthaven and a few other lenders prior to that. So doing the underwrite side of things had come in specifically to help us with the property side of things. But for me, I mean, I didn't even really know what a bridging loan was at that point. But we did have a network of introducers that had been sending through pawnbroking deals to us, luxury asset finance. So it was about hitting the phone, spreading the word of what we can do. So yeah, it was baptism by fire.
And do you remember a few of the first kind of bridging inquiries that you were getting? What kind of were they for houses? Was it commercial? What sizes were they?
Yeah, I mean, so when it was first launched, we were looking at the super prime market because that was sort of the clientele that we were dealing with already.
Right.
But did a couple of second charge loans on residents for business purposes.
Yeah.
A couple of light development loans, refurbishment, etc. But the assets, the property assets from that time don't stick in my head as much as the cars and the jewelry that we were looking at.
And the pricing was the same, or they
about one a month as a brand new lender to bridging, would tend to start out at. And I think at that time, I mean, that was probably where a lot of the market was at that point.
Yeah, and it hasn't drifted that far away from it, really. It's kind of always been around. I still say to people, if they're asking me how much bridging costs, I always tell them it's between 0.8 to 1% a month. It could be a little bit cheaper, it could be a little bit more, but somewhere in that range, you're always going to find it depending on what you're looking at.
Yeah.
So, okay, interesting. So you've got, now you're doing some, and then were you doing predominantly more of the property stuff, and like that the pawnbroking was kind of getting less and less and less? Was it 50-50?
The luxury assets was still the massive amounts of volume. Right. Yeah.
So why did you take the next step, and did they shut down their operation? Did you get another job? Did you get tired of it?
No, I mean, I'd been there for, say, I think it was 4.5 years or so, and just felt, sometimes, especially in sales, you can get the itch after a little while, and decided that, we were doing more and more property deals. A headhunter got hold of me, and I liked the sound of the next opportunity.
And the next opportunity was
Castle Trust.
Castle Trust. So tell us about Castle Trust.
So
and your time there.
Really funky products when I was back there. So we didn't do so much on the bridging, which I understand is massive for them now. It was a buy-to-let equity loan where you could service some of the interest, and then anything that didn't quite fit would roll up. So again, it was more positioned towards higher value, lower yielding property.
Right.
And it was very much a solution based, saying, well, like, it doesn't fit on traditional buy to let, but we've got this mechanism that we can do to get more equity out of these properties for you. And it was usually because an investor said, I want a maximum gearing on this property because I want to go and buy some more.
This episode is sponsored by Merry Oaks Property Finance Brokerage. Merry Oaks is a finance brokerage for investors, developers, landlords, SMEs across the country, helping you with all of your finance needs. So whether it's bridging, development, commercial, buy-to-lets, HMOs, service accommodation, industrial, hotels, the whole 9 yards, whether it's for your portfolio, whether it's for your business, we can support you. Please contact us. We've got the link in the show notes, and we look forward to hearing from you. Now, back to the episode.
Did a couple of large development loans while I was there as well. So it was my first sort of touch point on, lending against the initial asset value, drawdowns for the build costs, and working towards GDVs, etc. So it was a good spread of everything to do with investment property.
And how long were you there for?
4.5, 5 years. So dealt with COVID while I was there as well.
Okay, so you were there during COVID as well. Yeah. And then your next move from there, why did you move from there? Because Castle Trust is a good brand.
Yeah, no, absolutely. I wanted to do more of the bridging side of things, and there was more products came in that were just a little bit more like standard buy to let, and I like getting my hands dirty, getting my hands on a deal, structuring something, and saying, I still do say to brokers, like, don't try and tell me what product you want or how you want to do it. Tell me the numbers, tell me what the client wants to achieve, and then let me wrangle the products or how we can structure it to make it work for you. That is the thing that I love most about what we do at Octane.
And at Octane, I remember I was speaking to somebody else that worked there not too long ago, and he was saying one of the approaches to the market, kind of one of our marketing angles, is we don't really have a product. We've got a model, obviously, but we try to fit around whatever the client's requirements are and trying to be a little bit creative and agile.
Absolutely.
And so with Octane, now that you're with them, tell us about how that journey's gone since the day that you started and where you're at now. And the type of product range. This is the perfect thing. It's like a sales pitch almost. I know you're going to be very good at this. But yeah, tell us kind of all the stuff that you do in Octane. Because I know they do some really, really cool stuff.
Yeah. So when I first started at Octane, we were writing a lot of buy-to-let loans at that time. So a 5-year term. So a lot of people call it sort of a long-term bridge or like a mid-term product. So 5-year term with a 3-year ERC. And again, similar to Castle Trust, we were doing something...
Yeah, I was going to say there are some similarities between what you were saying before and that product.
Yeah, so where you could, we would defer 1% of the monthly interest, again, to then help interest coverage ratios.
Yeah.
But we were very much focused on the more complex side. I used to call it the sexy side of the buy-to-let. So expats, foreign nationals, first-time buyers buying HMOs, the sort of things where you could give a client a bridge to buy a HMO, but then a lot of the lenders wanted them to have 2 or 3 years experience. You don't want to bridge them for 3 years. We give them a 5-year buy-to-let product, but with only a 3-year ERC. They've got a lot of runoff there. Get them the experience, make them a bankable client. And it's just, we were charging more interest, obviously, than a traditional buy-to-let would, but it's that increased risk, but getting those clients bankable.
And that was a great product. You still do that?
It may be coming back very soon.
I was going to say, because from my memory, they pulled back. And it was just, I remember it distinctly because I was getting quite a lot of inquiries. I thought, bloody hell, this is going to be great for this thing. And it was just at that moment that you decided to pull back.
It was Liz Truss.
Ah, that was it.
Yeah. Because a way a lot of bridging lenders work when they lend on buy-to-let is not like the major banks where you have a large proportion of capital sat aside at a certain rate, warehoused or set at a particular rate. You know, when you put a mortgage in and the lender says, oh, we're pulling this product soon, that's because they've set all that rate. Smaller lenders tend to take the swap on the day that they write the loan.
Yeah.
So if I've given you terms 3 weeks ago, and we did used to complete buy-to-lets in auction timeframes, I give you a rate a couple of weeks ago, and now the swap rate's jumped up massively. Well, then I have to say just before completion, by the way, your buy-to-let rate is changing. When we're in a stable rate environment, that's a lot, you can manage that. But after Liz Truss came in and the swap rate started going crazy, then it meant that all we would be doing is having arguments with brokers and clients and letting people down and not being able to be transparent, which is what we've always been about. But we are coming down to a more stable rate environment, and I'd hope to see that product back in the not too distant future.
Fair play. So now the core of the business, core products.
Yeah.
Tell us about those.
So everything we do is non-regulated, and we are focused purely on, well, obviously property investors for that nature. And the majority of what we do and what I see is linked somehow to someone doing some sort of refurbishment on a property. So the big volume for us is on refurbishment funding, where we would lend towards the purchase of a property up to 75% and funding all of the build cost. So it works like a development loan in that your client spends some cash and then we draw it down in arrears up to, say, 70% loan to GDV. And we were, more or less pioneers when we started doing this product, and there's a lot more out there now. But we pride ourselves on that. We have funded over 1,000 refurb projects. Within that, probably 300 or so.
1,000.
1,000.
That's incredible.
Exactly, yeah. And doing this throughout our whole loan book with a default percentage of about 0.1%.
Unbelievable.
We pride ourselves on that, writing good quality business. But yeah, the refurb is the majority of what we do, even to the fact that a lot of the bridging that I do is somebody says, oh, Mark, I want to take a bridging loan on this. I want to take a refurb loan on this. I'm converting this house into flats. I don't need planning. I say, yes, you do need planning. They come back a week later and says, yes, Mark, we do need planning. I say, that's fine. We can give you a bridge to buy the property. And then once your planning comes in, we will rewrite our deal and then fund all of the work for you. So kind of like getting a land bridge and then a development loan.
So
but
you
just
can
on existing bricks and mortar.
It's on bricks. So you wouldn't do it necessarily on land without planning.
No. Again, we stick to what we know. Not trying to do everything. Residential, semi-commercial property. That is where our expertise lie.
And just like straightforward bridging for auction purchases. That's also what you can do.
Yeah, absolutely. We do prefer the deals. If it's a refurbishment deal where it's going to be 20, 30 grand worth of work, I always say to people, I'm not going to fight you for that business. There are other lenders out there who do that probably better than us or better suited because they can do higher leverage day one. I want the deals where you're spending 50, 100, 200, 300, 500,000 pounds on the build cost.
Right.
Because then, a 500 grand loan turns into an 800,000 pound loan. And we all want to write bigger ticket deals, right?
Yeah, indeed. We all work off percentages, and the bigger numbers they do. I mean, well, interestingly, so as much as, because this is a good question for a lender, as much as the bigger numbers pay better, is it a case, because different people say different things, and maybe there's thresholds for it, but it's just as easy to write a £100,000 loan as it is a £1 million loan?
I'd say that's probably true. Yeah.
Talk us through the process of the underwriting, whether it be 100,000 or £1 million. So from the start to the finish, kind of just so that there's going to be investors, there's going to be developers watching this, and they want to understand like what is the process? Like I need 100,000 or I need £1 million. What do I need to give you to underwrite it? What does underwriting even mean? Like what's the process from start to finish?
Well, I mean, at Octane, going back to what you mentioned as well about us not really having, we don't have a crib sheet or a product sheet per se. And one of my colleagues put this very, very well the other day in that having good product and good criteria is great. But the most important thing is understanding your appetite. So we also, I've been here 5 years. I've got a great understanding, I hope, of what the business's appetite is. In so much as that I can get a deal that comes in that doesn't fit our criteria or our loose products, but if it fits our appetite, I know it's a deal that we can do. So that I think is more crucial than actually what a product or criteria might say, because you might have great products and criteria, but then if you're not really sure, or the business isn't really sure where it's going or what the appetite is, deals can fall down at the late stages, which is not what you want. Going back to your most recent question about what does someone need to provide me on a deal, how much are you purchasing it for? What's the build cost? What's the GDV? And obviously, as we all know, what is the exit? The key thing from a bridging loan. And then other key things to understand. Have you got any experience doing it? It's not an app, you know, we're happy to deal with borrowers that have never done a refurb before. If you're spending over £100,000 on the build cost, probably expect you to get a builder in on a fixed price contract.
Yeah, so
we would vet that builder.
I was going to say, what are the, so give me some of the caveats. First time developers, first time people that want to do refurbs, etc. So you want them to have a good builder on board. Is there anything else? What else do they need to have to make sure?
Cash in the deal.
Cash in the deal, some hurt money, make sure they're not going to walk away.
Yeah, exactly. And, you know, I position this to people a lot of the time and say, look, we want the client to have skin in the game, because especially when you're dealing with a refurbishment, things can go wrong, or things can go awry, should I say. And if they do, and the client's got no skin in the game, it's very easy for them to throw the keys at Octane and go, sorry, I've messed up. Can you go finish this?
Yeah, it's no skin off my nose.
Exactly. So we want to avoid that. It's also why, and most importantly, when you're looking at flipping properties for profit, we want to make sure that the client's got enough profit in that deal.
Yeah, so it's got to be a profitable project. They've got to make sure that they've got a...
That's what makes a good bridging deal. As long as everyone makes money. Client makes money, lender makes money, and of course, Sam, you make money.
Well, of course, for introducing the right lender.
Yeah.
So what happens in the situation whereby a first-time developer, first-time refurb guy wants to come along? He's got a really good builder. He's got a really nice little project, and but he has literally got no money, and the money that he's got is from a third-party investor. So he has got money in the deal, but it's coming through somebody else is lending him the money.
So we're okay with that as well.
You're okay with that, yeah?
We are, yeah, but we may, rather than lending at 75% day one and finishing at 70, if there's a little bit less skin in the game and a lack of experience, we might say, well, we've got to be at 70 at the beginning and 65 at the end, because there is that additional risk. And what's the easiest way to mitigate risk? Decrease the leverage a little bit. But yeah, we have done those deals in the past. Yeah,
and typically to structure that, because we do get people asking this, and from working with other lenders, it's typically just make sure that the money that you're bringing in is subordinated to your first charge security.
Exactly that. Yeah, I mean, usually we see that they might have a loan agreement between the investor and themselves. If the investor wants to take a second charge behind us, we're generally okay with that as well.
Do they need to have a balance sheet? Do they need to have a net asset value of a particular amount? Or
no. I mean, we've lent to first-time buyers in the scenario that you've mentioned. Where they have an investor coming in. Now, I don't know how some people getting into property for the first time, they must be the most charming people in the room to have no experience, no cash, and then have an investor give them some money to invest in the first time. I mean, again, they must be super charming to be able to get that, or potentially very well organized. I mean, in the scenarios that you're seeing, is that I expect it usually to be they've met at a property education event or something, and you've got somebody who's got all the time to put in but no money, and you've got somebody who's got money but no time, and then they come together. Is that generally the situation that you find?
One of them's got the experience, they're an architect, they're a contractor, and they know their way around this, but they haven't saved up a bunch of cash, they don't own their own home, but they just stumbled across a deal, and we do all of our checks, you do the underwriting, like, well, bloody hell, that build cost does seem reasonable, that GDP does seem reasonable, and that purchase price is pretty keen, so you actually all does stack up. But it is a unique situation.
Yeah.
But I do have a reason why I'm thinking about this off the top of my head is that I've got an architect who he has got his own money, though. He's got about 150 grand of his own money, but he doesn't have any assets in the background.
Yeah.
So it will be his first project of his own accord, but he is in and around this stuff all day, every day. So he's drawing up plans, working with investors, working with developers, seeing what they're doing, thinking, I want to get in on this.
Yeah. All?
Yeah, exactly. So that's good to know. So
I guess the other thing, and going back to saying, you know, the client's not got a balance sheet or a portfolio behind them, the key things that we ask are, so the numbers on the deal. I mean, the address of the property is very helpful as well. Not that we always get it. Details of the client, have they got any experience doing this, or what's the most, likened project to this that they've completed? And what is their NAV? I mean, it's a bit more of an internal thing, net asset value. What is the estimated equity on their portfolio? And the reason that's a really important question is because if you send me a deal that I'm like, this is really pushing the boundaries, client's got no experience, they want to spend, £700,000 on construction, they've never done it before, they've got a good contractor. Oh, well, they've got a 20 million portfolio. It makes you a little bit more flexible. And the reason that that's important is because somebody who is a first timer and has no other assets in the background, again, going back to our core focus of refurb, things can go wrong. You're knocking properties about, you're pulling the back wall down, you're removing items, you're putting new rooms and dormers in, etc. Things can go wrong. If you have no other assets in the background and no cash, if things go wrong, you have no levers to pull. Somebody who has a load of equity in a portfolio or in their home, the proverbial hits the fan, they can get a second charge on here. They can pull a little bit of cash out of this other property to fix it. So it's how likely is it that if things do go wrong, can the client rectify that?
Thank you so much for tuning in. We really, really appreciate the support, and it helps me, gives me the motivation to get bigger and better guests on, all for you. I also wanted to let you know that I do have another YouTube channel. It's called Saam Lowni. It's just my name, and it's all about everything that I've learned in property and business over the last 20 years. It has site visits from our Marriott's clients, so you can go behind the scenes and see how they're getting on with their projects and the trials and tribulations, the successes that they've had, as well as some tips on my thoughts about the market, about the game of Monopoly, and a whole bunch of other things that bounce around in my head. We have the Monday morning musing, which I do send out on an email as well, but please do check out the YouTube channel at Saam Lowni. We'll have the link in the show notes because that's slightly different stuff, and I'm sure you'll enjoy that too. Otherwise, back to the episode. Yep, no, totally makes sense. And if I was the lender, I would probably insist. I mean, I shouldn't be saying this because I would keep it open. I want lenders to lend with people without a balance sheet in the background. But it's that worst case scenario. If there is a cost overrun, where are they going to scramble to get that capital? And if they don't have any assets in the background, then you might be scratching your head thinking, what are we going to do? But
how do we get out?
How do we get out? But I think one of the things that you said, which is fair, is how do you reduce risk? One of the ways that you can price it higher. So that's one of the. But
Octane would always rather compete on price than risk.
Yeah. So exactly. So sometimes I'm like, I give the lenders two options. I say, look, just either put the price up on them or bring the leverage down.
Yeah.
But on this occasion, they need the high leverage. So actually, it's got to be the pricing if you're going to get comfortable with it. But actually, from a lender's point of view, if I was a lender, going back to my lending days, the ideal is just to pull the leverage down a little bit and say you put a little bit more cash in.
Yeah.
That means you're a little more at risk. We're a bit safer, and we'll still get the deal done, and you're at a reasonable price as well, because hiking up the price doesn't tend to help them at the back end when things go wrong.
Exactly. But then also, getting into those clients who are starting their property journey, we do a good job. We pride ourselves on looking after a client, treating them fairly, not charging extortionate extension fees. And it means they come back to you again. And if somebody's flipped a property or they've created a HMO and exited it and they've had a good journey and you've treated them well and they've made money, they will find another deal and they will come back to us again and again. And therefore, you don't have to continually find, you need to find a few new clients, but then if they then tell their friends about it, we've got clients we've done HMO conversions for, they're now educating individuals on how to do that. And they send all of them to us because they say, this is a great lender to work with. They've looked after us. And the more and more you work with a client, the more you can maybe get a little bit more flexible with the parameters that we lend in. So supporting developers early is a real key thing in building a business, for the long term.
Because then you get the repeat business, and repeat business is the best business.
Exactly. Yeah, it is cheaper to retain a client than find a new one, right?
Yeah, 100%. And so the mission for Octane as a lender. So, going back into buy-to-let, which is great news. You heard it here first, exclusive. We'll look out for the official news to land. But as a lender, there's different ways you can go. You can go into pawnbroking and stuff, but you can go into term debt finance, which it sounds like you're going to kind of that short term, that kind of middle ground hybrid type product.
Yep.
And then you've got bridging, you've got development, and then you've got like the likes of like big names out there, like Together, which is the largest private lender. Does Octane have a bigger goal, a bigger kind of vision of where they want to go to at the moment, or are they just enjoying the ride, doing the fundamentals correctly, and then seeing which way the wind blows? When's
this going to air?
Well, today is end of February, so it's going to be through March.
Okay.
26.
There's some big news coming out soon, which will give you a bit more a heading of the direction that we are heading in. But yeah, buy to let coming back, and then some small tweaks to how we do our bridging, which should put more on our bottom line as well, or should increase our lending volumes. So the hottest thing on everybody's lips at the moment, so it's all the initiatives, right? We'll have BTL, HMO, LTV, AVM.
Interesting.
OMV.
Very good. And for those people that don't know what AVMs are and OMVs,
and this is something that you and I have spoken about a lot.
Yeah. I know.
So, this was actually something I was really keen to discuss. So 180-day valuations is a bit of a pain of yours, right?
It is a massive pain.
Okay. And what is the, from the broker's side or client side, what is the thought on what a 180-day valuation means?
It's very opaque. It's very kind of hard to define 100% because there's an element of subjectivity from a valuer or they're going to get data which isn't readily available. So they might be talking to auction houses and this sort of thing, which isn't typically how you go and do a valuation. So the interesting thing is, so we just talked about Together Money. So they do all 180-day, and they've got like a £6 billion loan book. So they obviously doing something right, and they're getting the capital out the door. But that being said, the borrowers that come to us, they want speed, they want the lowest price, and they want somebody to be super flexible, right? That's what they want.
And no money down.
Yeah, exactly. Very flexible, right? So that's what they want. And to give them all three, I always say you can't have all three. You got to sacrifice one for the other two. But ultimately, leverage is very important. So I want to put as no money down or put little money in the deal as possible. And around all of that, they want certainty. So it's not, hey, this is on paper, this is indicatively what we can do.
Yeah.
I want to be able to trust the process, because the process for bridging can be anywhere between, let's say, on average, 2 to 4 weeks. That's what it should be, thereabouts. It's going to take a bit longer. I think I saw a statistic said the average bridging loan in the UK
completion time 58 days.
Yeah, something like that.
Yeah.
I was going to say 60. So yeah, and I was like, oh, that's a bit crazy. But we tell everyone it's 2 to 4 weeks, so that's literally what we're usually working towards and achieving. But in any case, 2 to 4 weeks, and we don't want any nasty surprises as long as there isn't any material changes, which is fair and reasonable, and that's how we approach everything. Everything is subject to underwriting, valuation, and legals. Now, the valuation part is where you can have a variety of disagreements, and dealing with investors and developers, for the most part, they are relatively an optimistic bunch.
Oh yeah,
I mean,
rose-tinted glasses.
Your average homeowner always thinks that their house is worth more than everyone else's on the same street because they've just done the bathroom up, because they've got a couple of inches extra on the garden at the back, and the rest of it. And the developers, obviously, they're running their spreadsheet and they're thinking, oh, if I just get that little bit more, if I, that one comparable that's that anomaly that if I can achieve that or break the ceiling price on that, and I should be able to because I've put in this, this special type of kitchen, etc., etc. They want to achieve more. Now, the valuers never see it. Well, not never, but on a regular occasion, don't see it eye to eye. And what we're trying to do is achieve the maximum LTV, the maximum leverage, and the only way to get the real comparable evidence is to go to the agents and say, what have you sold here, what have you sold there, what have you sold there, and those are sold house prices, market value. So when you go, I mean, I've typed it into Google before, and it's what is a 180-day valuation, and it says anywhere between 5 to 15% below the market value.
But that's the main thing that I wanted to sort of for you to pick up on, so I'm glad you said it, was that it should not be, and I've spoken to valuers directly, it should not be an arbitrary figure that they put on it. But I think it also more comes down to what is the definition of a 180-day valuation. Some may say, we want to get this property offered and sold within 180 days. Now, the average time to complete a sale on a property over the last couple of years was over 6 months.
Really, yeah, the average house.
But then we speak to some other valuers and they agree that, we say, we want 180 days to be reflective of the time to be able to secure a proceedable sale. And therefore, a lot of them then say, well, that's open market then. Now, that's obviously not a guaranteed. And I know what you're trying to avoid is that situation where you get a valuation back and it says it's 450,000 OMV, but it's 440. And it feels like the value is just, as you say, just taken off that little bit of a figure, because then that's an argument between you and your client that you have to deal with. And if you can avoid that and just have OMV, it takes out some ambiguity. That's what you want, isn't it?
That's what I want. But the problem is that 450 and the 10K that you mentioned, most people can live with that.
Right.
Actually, I was in a room full of developers and I said, all of my valuations typically always come out more or less where I want them to be. And he was like, none of mine come out. And I was like, really? None of them? Like, you're doing something wrong. And he was like, well, yeah, I said, give me an example. He said, well, it was an HMO that I did. And instead of coming in at 500, I got 490. I was like, that's close enough.
Yeah.
That's a few of mine have been 5, 10, 15 grand here or there, but you've more or less got the number. You're not kind of wildly out.
Yeah.
But the difference between 450 in the example that you use and 10%, that's £40,000 that they've just knocked, £45,000 that they've just knocked off of the value. And that significantly starts to move the needle. And that's what we're trying to avoid. 5% less so, but if it's 10% I went in the middle, if it's 15%, and it just gives too much. I
think that comes down to
uncertainty.
What the final definition. Because if you're saying, well, look, this property is worth £500,000, but if you want to get a property sold within 180 days, then it may well be that drop. But if it's a proceedable sale, then it should be closer to that. Because if you're saying you want a property sold within 180 days, well, really, you need to get a proceedable offer in a week.
Yeah.
So therefore, is it more like an auction valuation?
Yeah, exactly. You know, interesting actually, because I've been an estate agent for many, many years. And if we took over 6 months to get an offer on a property, we're doing something very, very wrong.
But that's where the market is at the moment, I think. It's slower. I mean, it's why our other product, development exit finance, has been really popular, is because things are taking longer to sell. People need more time.
Which is fair enough. And like I said, if you go to whatever, every lender sets out their stall and they say, look, this is what we can go up to. And there's some rhyme or reason for why they do that. And usually is down to personal experience. They've got burnt on something or other. We can't do, some bridging lenders will do a house which has got fire damage and some won't.
Yeah.
And it's typically because they've heard some horror story
or experienced it.
Yeah, or experienced it firsthand, exactly. So it's and that's fine. But the ones that haven't necessarily had a bad experience with it or had heard any horror stories are like, no, we'll do that. Why not? Out of interest, fire damage, would Octane fund that?
No, not really interested. And the reason that I think I've been given before is that when there's been a fire in the property, the smoke can create damage within the fabric of the building that you cannot see with the naked eye or necessarily with the survey. So it's usually something that we avoid. I have got another example for you. So I saw a valuation. It must have been last year. And it was, somebody had bought 2 flats in a new tower in London and then amalgamated them into one. The valuation of this flat was £14 million. But the valuer's comment said, this is one of the most illiquid properties we have ever seen, and we expect a time to sell of more than 24 months. Yeah. Now, would you want your client to borrow off of the OMV in that situation on a 12-month bridge?
Would I want them to do that on a 12-month bridge? I mean, you got to look at what the exit is, yeah. So ultimately, if there's no way that they can get a secondary exit, because I think with bridging, if you're going to take it out, there's one thing I always tell people: you need to make sure that you've got either sale or refinance, or you can inject more equity into the deal at some point, or take it out. You just need to be thinking about that from the get-go. Yeah. So I wouldn't necessarily. I mean, but then again, at the same time, I have a policy whereby I try to treat all the clients like adults. Right. And I tell them, I tell you that one of the biggest...
Even when they throw their prams out, they throw their toys out the pram at you.
I do my best to hold my nerve. But the point is, when we talk about land without planning, so I get people calling me up and saying, hey, I want to get a bridge and I want to take this through planning. And I have to, the first thing I say, look, I can help you with it, but I just want to tell you that this is a very, very risky thing to do.
Yeah.
Because if you're going to get a 12-month bridge, typically planning could take, but like if you put it the planning application, they say they'll get back to you in 3 months. I'm like, yes, that's what they've written on the website, maybe.
Yeah. This is the determination deadline. If I've seen any of them hit in the last little while.
Exactly. And I can give you a whole host of people that have taken much, much longer for many, many reasons. So as long as you are aware of this and you understand like the consequences of not being able to repay and you've got some backup contingency, then I'll arrange it for you, because we're not doing anything illegal. They're adults. They're allowed to put themselves in a position of risk, and who knows where they end up at the end. So as brokers, we try to be objective but also responsible.
Yeah. And it is a roll of the dice. And, if it comes off, they make a lot of profit. I mean, we sometimes see it where, going back to the situation I said where someone says, I want to buy this house and I want to get planning to turn it into 4 flats. And we often say, what are you going to do if you don't get planning? Well, I might stick it back in auction. I'll take the hit if I have to, or I'll give it a light refurb. But that's the thing is, we're lending at 75% on a purchase of a house. They don't get the planning that they want. We're protected on that as well, but clients are, they're putting their money where their mouth is. So we're happy for those clients to roll the dice as well.
That's it, exactly. So from a broker's point of view, I will always arrange something for somebody. As long as they're not doing anything illegal, if they're taking on risk, there should be a reward at the end of it. And as long as they're taking steps to have a variety of exits, then that's down to them. That's kind of like, I'm not here to mollycoddle or mother people and say, you shouldn't be doing that with your money. That's your choice. From a lender's point of view, putting my lending hat back on from my days, then yes, actually, what LTV would I go up to on a £14 million flat, which is very illiquid, that the value has told me it's going to take 24 months plus to be able to find a buyer? I would be very, very cautious. I'd probably, I might just off the top of my head not go above 50% on that all day long, right? So so that's and I mean that's a lot of money to tie up into a very high value single unit property.
Exactly. Yeah, it was just an example because I was interested to see that the valuer's comments were, this is extremely illiquid and it will take more than 24 months to sell.
And it's easy for me to then, if a lender, I think a lender came back and said, we're not going to go up to 75 as per our rate card on this because of the valuer's comments. We can go back to them and say, well, within, this is reasonable actually, and hopefully £7 million will solve your problem.
I think it was interesting what you just said about treating clients like adults as well. I try to pride myself on it. I get numbers through on a refurbishment deal, and without trying to be too much of a naysayer, just come back to the broker with the reality. Your client's numbers mean they're going to make a 50% profit on cost by spending £50,000 on an okay looking terraced house. It's not going to happen. Either the build cost is too low, the GDV is too high, or it's usually a little bit of both. Yeah. But I always say to people, look, lean on our experience. Like if you're doing a HMO conversion, for example, in some of the areas that we do loads in, Portsmouth, Bristol, Nottingham, bring the deal to me. Let me know the postcode and the client's GDV. If your client's saying their GDV is going to be 850, and we've done 8 in the last year, and they're only at 650.
Yeah.
I'll run the numbers based on 650. Now, when we get the deal in, yes, we'll send it at 850, but I'm only going to do that if the deal also works at 650. If there's no profit in it, and if the GDV does come in at that figure we think it is, and it means we can only lend them 50% day one, all we're going to be doing is having your client spend money on the valuation. I don't want to do that. Waste our time, your time, underwriting time. So going in with, an air of authority that we know what we're doing, 1,000 projects funded, but also not wanting to be too much of a naysayer. Sometimes, I'll potentially be a little bit cheeky and be like, oh, maybe there's something, maybe you missed a zero off on some of these figures because it's not quite working. But certainly, brokers that I deal with on a regular basis, I can be quite blunt going back and saying, look, these numbers don't work. This client clearly doesn't know what they're doing. But then you're there to buffer that and go back nicely to the client. That's why I like dealing with brokers, is because I can give you warts and all responses, but expect warts and all inquiries from you as well.
I mean, we try to. I've got one in Liverpool at the moment, which is a hotel C1 above, and it's got retail on the ground floor. and his build cost is a little bit light, his GDV is a little bit optimistic, but his margin is through the roof.
Exactly, but that's the main tell. You know, when we're looking at a refurb deal where the client is selling the property for profit, we want them to be making around a 15% profit on cost.
Yeah.
Give or take. Now that's after stamp duty,
yeah.
financing, maybe throwing in, you know, what's an agent going to charge them to sell this property?
Yeah, every cost,
legal cost, etc. Now, when you get a deal in and you see that, you know, it's approaching 35 plus, that's when sort of questions come in. But at the same time, you know, we're not here to pre-underwrite deals before they've come in, but we want to avoid the situations where there's a 30% down val on a property. That should be avoided, and that can be avoided. Like the way that we work, the process is I get the information from you on the client experience and property. We send that into our underwriting team. This is before the application's in.
Yeah.
They look at the client, look at the property, look at the scheme, have a quick look on comparables on Rightmove, what's sold in the area, just to make sure the figures are right, so that when we go back with an AIP, it is credit backed, or you've had an underwriter look at it. And they sometimes, if I don't, they might pick up and say, nothing in this area has sold for anywhere near the client has said. What makes their property different is the nice way of asking, or something's wrong with this deal is sometimes how they're a little bit more brutal with me.
I mean, the only time that I was just thinking off the top of my head that can work was if you've taken something through planning, where basically you've got an option agreement, you've secured it subject to planning with an exchange delayed completion or something along that line, and then you've added value through the planning and your residual land value is higher.
Absolutely.
But if you're just buying something that's a mid-terrace house and you're doing some refurb work to it, to be able to have some buying it below market value, it's a little bit more challenging, because out of interest, below market value transactions, OMV and stuff. So what some people say, below market value transactions do not exist. I had a lender tell me that the other day. I don't believe in that rubbish. Pardon?
Might have been me.
Is that right? There you go. So tell me his thoughts. This episode is sponsored by Merry Oaks Property Finance Brokerage. Merry Oaks is a finance brokerage for investors, developers, landlords, SMEs across the country, helping you with all of your finance needs. So whether it's bridging, development, commercial, buy-to-lets, HMOs, service accommodation, industrial, hotels, the whole 9 yards, whether it's for your portfolio, whether it's for your business, we can support you. Please contact us. We've got the link in the show notes, and we look forward to hearing from you. Now, back to the episode.
So look, as I mentioned, you know, drop the bomb that we are, you know, we're going to be moving to OMV and AVMs, automatic valuations, hopefully within the next 6 weeks or so. So that will probably open up a conversation with saying, "Oh, I'm buying this for 300,000, but you've got a valuation on your AVM of 450. What are we going to lend against?" Going back to what we discussed earlier, we like skin in the game.
Yeah.
The problem, and this might be just my opinion of what I've seen, is that a lot of the BMV transactions that I tend to see are chances who haven't got any money. I don't want to put anything into this. I've got this great deal. They've got no portfolio. They've never done anything on property before. I'm guessing they might have watched a couple of YouTube videos on how to invest in property. And they want the lender to take all the risk. And sometimes I've looked at some of these deals saying, "Oh, why have you got this BMV? I'm a great negotiator." Well, how about it's been on the market for 8 months and hasn't got an offer at the figure? You're not buying it BMV. You're getting it for what it's worth.
Yes.
The crucial one that I see lots of is that a client might be saying they're buying a property below market value, but then they're also intending to do £250,000 of work on that property. Now, if they bought it at the figure that the vendor had it on the market for, they don't make any money.
Yeah.
So what we're looking at there is residual value, especially if you're flipping a property for profit. GDV, less your costs to get there, build cost, finance cost. That's how you get down to that residual land value you were speaking about. And the difficulty a lot of the time with refurb, and what I spend my time talking to people about loads and loads, is that if you're buying a house to be refurbed, don't forget that the vendor is selling a house. You are buying a site. And that's how it has to be treated. And I have seen many clients or brokers come to us sort of later in the day. They've gone to a bridging lender, got an AVM on the purchase of a property, got halfway through the refurbishment, but they don't have enough money to finish it. And when we look at a residual value, because they've taken the roof off and they're changing it into an 8-bed HMO and they need to spend another £200,000, well, you bought it for 400 grand, but you should have bought it for 300. And we can't help you at that stage. And I think that's maybe a little bit of short-sightedness with just jumping in with AVMs all the time. You know, what is your overall plan? Have you costed this all out? I know it looks like a good deal, but jumping into it just to secure it could lead to problems down the line.
So, you know, on HMOE stuff, how do you look at this as well? Because sometimes people will, you know, that 20% margin on the residual land value, which is a RICS calculation, where you take the end value, GDV, knock off 20%, knock off all your build costs, finance costs, everything, get to your residual land value.
We asked the valuers to take out the profit in their residual calculation.
Oh, is it?
So again, going back
because you will allow a tighter margin on the uplift.
Absolutely.
Because sometimes these properties are really good for the high yielding income producing element.
Exactly that, yeah. So when we look at HMOs, there's a few tweaks that we made to our product to make it more suitable. But the first one is going back to Refurb, saying we want them to make 15% profit on cost, etc. Yeah. If you're making a HMO, you don't need 15% profit on cost. Your profit is going to be 4 times the normal rental income over the next 10 years or so, right? So we don't need to see that there's a profit. We can even suck up a small loss that the client might be making on paper. Because we know that loss is going to be made up within 2 years to get back
6 months, 12 months on some of these high yielding stuff.
Exactly. So that's why when we instruct valuations on and we need a residual calculation, we say to the valuer, take out the profit or add it back in, because we are not taking that into consideration. And then that can, you know, if the residual value comes down slightly because of the profit, you add it back in, we can get it back up maybe to where that purchase price is.
Behind the curtain in a lending business, you've got people like yourself, incredibly passionate, incredibly enthusiastic, incredibly knowledgeable about how all of these different little nuances work and how these things work. And then you've got the underwriters that sit and underwrite. Have you ever thought of moving to become an underwriter?
No, my attention to detail is nowhere near where it needs to be an underwriter. I mean, we pick up things all the time, and you know, it adds into my sales pitch, etc. Learning all these, you know, little bits about certain reports that might be needed, or ways that we can treat credit, and you know, CCJs or something like that. But the actual underwriter that did that is heavy. And I say every man in the world's got ADHD, but I do not have the attention to underwrite.
Everyone's on the spectrum, but
yeah. But I guess also, like, going back to what I said earlier, like a good deal is a deal that fits your appetite and everybody makes money on it. But then, of course, you say the nuanced information about client background, source of wealth, source of funds. There's a lot of heavy lifting there that I'm just not in the mode to be able to take over.
Yeah, I mean, it's so important, that sort of stuff, and it's very process driven, and it's some of it. I mean, I wouldn't say it's as exciting as the stuff that you do, getting out, meeting people, looking at new projects, saying yay or nay in the early stages, originating. You kind of get right into the nitty gritty when you're doing the underwriting.
I would say though that with the underwriting team at Octane, we pride ourselves, and it was a couple of the main factors that helped us win 2 service awards last year. Our underwriters are visible. So once we get the deal in, you will speak to the underwriter straight away. We do have a landline number. Who picks it up, I don't know, because you will have direct access with the underwriter's mobile number. And if we need to speak to your client very early on in the process, we are happy to do that as well. And I think especially when it comes to lending and clients' experiences with banks in the past, we really want to communicate to people that getting lending from us is not a magical combination of answers and documents. We are people. We are here to lend money. And our underwriters are very much on the forefront of speaking to clients, working out problems early on and pushing through.
I think that's a very important part of specialist finances, being able to actually have a conversation with, because there's always little nuances, there's always certain things, and having that regular communication and transparency in the process is incredibly valuable.
Yeah, and like one of the key underwriting points for us is source of wealth and source of funds. And it can often be the case where, what's your source of funds? Savings. Okay. Pablo Escobar also had savings. Where have the savings come from? And like the classic example is, it's all come from savings. You go towards the day before completion, and it turns out Aunt Beryl gave them a gift to go towards this. Oh, we need a deed of gift. But she's in Mauritius for 2 weeks. So now you've held up your saying. So being completely open and honest. But when it comes to source of wealth and source of funds, the client might have sold a property, refinanced a property, had a windfall, got a big bonus, etc. Doing that over email can be difficult. So if there are multiple streams, I suggest broker, underwriter, client, not me, I'd be useless. Get on the phone, because the underwriter can maybe go, just tell me where the cash has come from over the last couple of years. Right, I understand. I need this completion statement, this refinance, and we're going to need a deed of gift from Auntie Beryl.
And what about things like the credit committee? So a lot of people hear credit committee and they think this is like the people that nobody knows what they look like. They're faceless, nameless, and they get together in a very dark room and they make some like life and death decisions.
I couldn't work at a lender that will operate like that.
How does it work at Octane? So how do you make credit decisions and get approvals?
So we, again, because we're quite specific in what we do, and when I send an inquiry in to get a credit back to AIP, the underwriter's looking at it constantly. There is such a firm grasp on what makes a good deal for Octane. And we pride ourselves on doing that sort of pre-underwrite to get the AIP out, that if everything stacks up and it is as it is, this is what your deal's going to look like.
Yeah.
You know, not moving the goalpost is a really important factor. Now, look, if the valuation comes down and I've gone from 60 to 70%, of course, the rate's going to have to go up because that's our risk profile. But when it comes down to a credit committee to get a decision made, it's a very, very short process. We sit in an open plan office. Everybody's talking about the deals, and we can get decisions made, as I say, very, very quickly. But anything that's a particularly large or complex deal, that'll be talked about with the head of credit, head of structured finance from day one to say, if I send an AIP out on this, do we have the appetite for it? And that is crucial.
So there's not like a regular, like Tuesdays and Thursdays?
No. If we need to talk about a deal, we're going to do it today.
Fair enough. And in terms of the best way to approach property finance, would you recommend that people go via a broker or go direct? Do you have any preference?
Well, go to a broker, because you probably, we all know there are 200 odd bridging lenders out there. The majority of brokers I speak to say they want 10 that can do everything, from your low cost, really, really easy deals to the stuff that's really quite hairy and on the appetite of what you as a broker would want to place, and then everything in between. But you probably only need, as I say, 10 or so lenders to cover all of that. And it's all about, from a broker's point of view, working with lenders that you can talk to, pick up the phone with, have good rapport with, believe that they know what they're talking about and they understand their criteria. I mean, you never want to send a deal to a BDM and they go, yeah, sounds fine, send it in. Oh no, we can't do this.
Yeah,
I mean, that's
slow, painful no's. I'm against them.
Exactly. But no, the best way absolutely to go through a broker, because you can send that deal to the 3 lenders that are suitable for that. Then it might be playing the rate game. It might be who can do it most effectively. But a client going direct to a lender and then maybe getting further down the process, and then something does fall out of bed, it doesn't fit, they've then got to go and apply again. Yes, you as the broker would have to apply again, but you go, I've got all these documents, bang, here you go. And you plug them into another lender and find them a solution more quickly.
Appreciate you saying so. Yeah, I agree. I mean, there's so many different lenders out there, and it just acts as a little bit of a filter. First and foremost, you don't waste loads of time going to people that are not going to be interested, or getting those slow, painful no's. And you make sure that you present it in the best possible way. It's not 100% work every time, especially the more complex the case. But I happen to agree with you, but for obvious reasons.
Well, especially when you're dealing with complex finance scenarios, although it's non-regulated, you want to make sure that clients understand what they're doing, and therefore a broker with FCA permissions, etc., can make sure they're giving them that best advice, and that clients aren't getting into agreements that they don't understand. Because a lot of people, for myself, I work in specialist property for 10 plus years now. I don't try and get my own mortgage from my bank or do a refinance. I pay a broker to do it.
Yeah, exactly. You go to a mortgage broker and then they go to Santander and Leeds Building Society. You'd never go there.
Yeah, because I don't understand. I mean, it's probably maybe I overcomplicate it, but lenders are looking at what's the ONS data of how much this guy can afford, what is the 5 times, 4.5 times income, and for some like mortgage brokers, that's easy for them. But then sometimes mortgage brokers understanding specialist finance is a little bit more complicated, which is why I often boil it down to, if everyone makes money, it's a good deal. I speak to some people and say, well, what about the affordability on this? I'm like, doesn't matter. It's making 100 grand on the flip. Don't care about affordability.
Yeah, fair play. And in terms of people that, projects on time and on budget, people that are going over the term, so you're doing typically 12, 18.
Yeah.
If you're on a build, you might be on 24 months, small, medium stuff. What happens if they go over the term at Octane? Is it something that is taboo and shouldn't be done? Or is there other mechanisms?
No, we want to work with clients and give them the best opportunity. We do charge a fee for extension. It's usually about between 0.5% and 1.5%. If, for example, we've done a refurb for a client and they've finished it, but they now need quite a bit more time to sell, we might offer them another product, a sales bridge after doing their refurbishment. Yeah. But as I mentioned earlier, in the lifetime of Octane, 0.1% of our book is defaulted. And that is something that we're incredibly proud of. Another thing as well is that although we've never charged anyone default interest, which I think is pretty noble. We had a client of ours recently, 9 months overdue. We worked with them, got them an exit. We'd dealt with them a couple of times before. So we knew they were good for it. It's just that this project had overrun. It was a little bit more difficult. They got out. We got paid back. We've got another deal in for that client. Yeah,
exactly. The repeat business is where it's at, any good business, that's literally where you make most of your money. And I think the more you're focused on that customer service, on the satisfaction of the customer and the client, the more your business should thrive.
Absolutely.
So I've got a few quick fire questions.
Okay.
So let me start with, what was the first thing you thought about this morning?
Why my son was punching me in the face at 4 a.m. I'm part of the 4 a.m. club, but not for the reasons that a lot of people are.
How old is your son?
He's 4 years old. He still gets into our bed every morning, somewhere between 3:30 and 5:30.
Enjoy it, mate.
Yeah.
Well, at last.
No, exactly that. I'm not kicking him out. It's going to be over too soon, right?
Yeah, exactly. What did you have for breakfast today?
3 egg omelette.
3 egg omelette. Okay, fair play, mate.
I usually skip breakfast because it's easier to try and keep the weight off, and now I'm getting a little bit older.
Yeah, fair enough.
Yeah, 3 egg omelette.
Favorite emoji?
Rolling, crying, laughy. That's the one that gets used the most.
Fair enough. You've been on the you've been on the light side of the lender. Would you ever switch to the dark side and become a broker?
Well, yeah, I mean, seeing the proc fees that we pay some of you guys, it's very, very tempting, that's for sure.
So you would think about it?
Potentially, yeah. I mean, I've
you
been
would
told
never
by
rule
others
it out.
that I explain finance quite well.
You
and
do.
can drill down to appetite and what makes it right, etc. But I'm having a great time, being out on the road, traveling around the country, meeting brokers, spreading the word of what we're doing. I'm having a great time at Octane.
Fair enough. If you ever change your mind, let me know. I'm joking. And then, okay, if you could flip the mic and ask me one question, what would that be?
Oh, okay. I'm gone blank. Would you ever go back to the lending side?
Potentially, yes.
Yeah. But if you if you were lending your own money?
No,
or if you had a funding line?
No, I don't mind a funding line or my own cash. Ultimately, I think that the market for lending, for debt in particular, is incredibly competitive, especially for bridging. So it would be heavily caveated a return to lending. And largely it would be down on two approaches. One, I'd need to make sure that the cost of capital that we're getting is at the right place, because I just don't want to be at the higher end, because I think you're just doing riskier deals, not the kind of stuff that you want to be doing a lot of. Octane's pricing is incredibly competitive, probably most competitive in the market, in fact. So that's I want to make sure that the margins are good, getting the right bucket of capital to work with initially. And the second is, I always have these growth aspirations in that if I started in bridging, which is always it's an easy entrance into the market, then to go into development refurb, which is kind of where my core kind of expertise is, and then I'd also want to go into term loan debt as well, similar to what Octane are doing as well.
I guess it's a natural progression, right?
It is, yeah. And then so you look at lenders like West One, for example, who've done incredibly well. I would want to kind of go on that journey. So it would be heavily caveated, starting in the right place with the right cost of capital, and with the idea of growing into these various buckets. Because I think things like development, if you're just doing that and the market starts to get a little bit choppy, your loan book can take a bit of a hit.
Yeah, I mean, like if you're working on developments all in a certain particular micro location, because that's where you know really well, and there's a change in the market or difficulty, again, it's high risk. Why it's why banks, in the challenger banks, when they're looking at development finance, they have to put a hell of a lot of risk weighting on that, because it is a risky market. But yeah, I mean, look, that sounds like the trajectory that you need to go on.
Yeah, and then I also like equity as well, because I think equity is incredibly high in demand.
Harder to find at the moment, or is there a lot of people out there?
No, loan supply always historically, and it always will be that way. So if you can deploy capital and be a good judge of where the winners are, you literally have a huge amount of choice. So
the equity provider has the choice rather than the developers having the choice.
Yeah, the equity provider, because literally, like from an origination point of view, there's not everybody needs equity, but there's a lot of equity requirement. There's a lot of demand for that.
Yeah.
I mean, you can see how much demand there is for debt alone. Just imagine how much there is for, like, there's probably double the amount that want equity, because most people come with their own money, but there's a lot that don't. And they want to do bigger deals. They want to do more deals. They've got good track records. And so you've got to be able. So what you end up doing is having a huge amount of choice, and probably because the returns are so high, you could put out a lot less capital and make a similar amount of money
with a good return. Yeah.
Yeah. So that's what I'm thinking. But first and foremost, I love being on the broker side. Yeah. It goes back to my origins of being an estate agent, a middle person. We get paid the least. The developer gets paid, the lender gets paid the most relatively to what we do. But that's fine, because I appreciate that you guys are taking ongoing risks for a much longer period.
Don't forget, most lenders have cost of capital as well, so the margins may not be as large as what they.
Exactly. So we get paid a fraction of what everybody else does. And
also, unlike most valuers and surveyors, sort of valuers and solicitors, you, like we, only get paid when the deal's done.
And that annoys me, I must admit. Because solicitors and valuers, they get paid come rain or shine, and we always have to take the hit when it doesn't go through. So, but I'm okay. Again, like going back to my estate agency days, I always promised myself in those days I'm not going to do this that way, because I don't want to have all this kind of like anxiety of whether I'm going to get paid or not. I've done all the work for it. I should be getting something, but I've ended up falling back into it, and I'm okay with it on balance. But the risk reward ratio currently for where I am in my life, I've got a 5-year-old daughter. I'm comfortable with it, and I'd like to think I'm quite good at what I do as well. So for the time being, I'm happy, and we're building a good team and everything. So I don't want to rock the boat with any of that stuff. If you try to do too many things at the same time, you don't do anything very well.
Oh no, exactly. Yeah. Well, going back to what we said, niche, know what you want to do, exactly. Become an expert in that field.
Exactly.
It makes it easy to sleep at night as well, right?
Exactly, and wake up early with somebody punching you in the face. So, what is the best piece of advice you've ever received?
Best piece of advice? Just be yourself, I think. A lot of people, a lot of people talking about on LinkedIn at the moment is you don't want to see this big fake thing. If you're talking about getting up at 4 o'clock in the morning, make sure it's because you're getting punched in the face by your son, not because you're going for a run at that time. Just being genuine. And I mean, one of the bits that I always say, and I had it this morning, I asked somebody a question. They said, I don't know, I'll go and find out for you. That is so powerful. Like, BDM's bullshitting, saying, oh yeah, of course it should be fine, and not knowing the answer is way worse than going, but you know what? I don't know that.
Yeah.
Let me find out and come back to you. And I'll come back to you quickly. That is what I think is key. But as for advice that people gave to me, I'm from the school of hard knocks, man. I learned it all myself.
Fair play. What's the worst bit of advice you've ever received?
The worst bit of advice? Just be yourself, Mark.
Best in the world. I was going to say, good advice, be yourself, because you're lucky you've got a good personality and you've got a good kind of work ethic and all those other things. But, the worst piece of advice is the same. Oh, don't do that. You're embarrassing.
Yeah, exactly.
We'll get that when our kids are a bit older for sure.
Indeed,
anyway.
Yeah, that's the aim.
And finally, if people wanted to reach out to you and connect with you, pick your brains about property, about finance, about development, about all the things that you've been talking about today, what's the best way they can find you?
LinkedIn. So I don't do any other social media. It's probably why I'm so much happier compared to most of my peers. LinkedIn's the only social media that I have. You can find me on our website, and then various shows throughout the country: Property Developer Show, Property Investor Show, Landlord Investment Show. Octane will be there. I will be at a lot of them as well. But yeah, always happy to have a conversation about what we might be able to help with.
Immense amount of value in this one.
Thanks so much.
I know people are going to enjoy it, and we'll come back and talk about all the stuff that you're going to be doing after some big announcements, and I look forward to working with you more in the future.
Pleasure. Thanks for inviting me on, Sam.
Cheers.
Cheers.